Hello, everybody, and welcome to Taxes in Retirement. My name is Brad Gatto. I'm going to be your educator for today, and I'm very excited to be here with all of you. Not only do I love education, but I also love the fact that people that attend these webinars are doers. Let me explain to you what I mean by that. As I see it in my 16 years in financial services, there are really two types of people when it comes to money. There are drifters and there are doers. Drifters are people that let their money kind of guide their life. Doers are people that let their life guide their money. And by the simple fact that you took the time to register and actually attend today's workshop on taxes and retirement just proves to me as an educator that you're a doer, that you're trying to educate yourself on these very important topics. And naturally, not only do you want the education, but you're going to want to do something with that education. So that's exciting to me. That said, today is going to be a journey, the journey on education about taxes and retirement. We go through a lot of journeys in life, one of which is this idea of retiring at some point. Now, mountain climbing is a great analogy. And I love the idea of the fact that you have to climb mountains. But of course, once you get to the top of the mountain, you have to descend. You have to come back down. You can't stay up there. In fact, the most popular mountain that I'm sure all of us have at least heard of is Mount Everest. It is the tallest mountain in the world. And there are many people that attempt climbing this mountain every single year. And I bring all this up because to me, it kind of equates to retirement, because retirement is really one of the biggest mountains we try to climb in life. There's not a lot of other goals or things that we put our mind to that we prepare for decades upon decades. And so Mount Everest is a 60-day climb, 60 days to get up and back. 2019 was actually the highest number of people that ever attempted to climb Mount Everest. There was 1,120 people that attempted to climb Mount Everest in 2019. Of the 1,120, 858 of those people actually were able to summit Mount Everest. That's about 76% of them. That's a lot. So about 3 out of every 4 people that attempted to climb Mount Everest that year actually made it to the summit. So that's pretty impressive. More interesting to note is that over half of them were high altitude workers or Sherpas, local guides helping people get up Mount Everest. And so although there are 858 people that made it, the majority of them were guides helping them get to the top of that mountain. Now, they got up there, 858 of them got up there. Again, over half of them being these guides. On the way down, on the descent, 8 of them passed away. See, when you're climbing Mount Everest, we all know it's a treacherous climb and that it's a dangerous thing. But not only is it dangerous on the way up, it's extremely dangerous on the way down. And so that all equates to or relates to this idea of taxes in retirement. I'm here to try to help be a guide for you and give you some education as it relates to this idea of paying taxes or minimizing your tax bill in retirement, and to be one of the over 50% of people that helps you get up there. But we also have to be cognizant of the descent. And the day you retire is like summiting a mountain, right? You worked decades to get up there, but then you have to figure out how to come back down the other side. And so that's what we're going to focus on today, is the descent. So our agenda for today is pretty simple. I'm going to give you a little bit of an introduction into not only who I am and why I'm your educator for today, but also to a bunch of resources. Because not only do we have a bunch of great education for you today, we have a bunch of resources for you to tap into after the fact and after this 60-minute educational webinar today, so that you can continue down this path of minimizing your tax impact in retirement. I'm going to go through what I think the primary problem is and expose that. Then we're going to go into Taxes 101. This is really just kind of how the tax code is set up, and to discuss this thing called the TCJA, or Tax Cuts and Jobs Act. Now, I realize some of you on today's webinar, because there are a lot of you, probably file your own taxes and are very familiar, at least with the fundamentals of how the tax code is set up for individual filers. But stick with us if that is you. Okay, because I want to make sure that we're all on the same page, because we are going to get into Taxes 201. And this is really a deep dive into the sections of the tax code, at least the major ones that affect retirees specifically. And then last but not least, I want to leave you with an immediate impact. So what we're going to do is go through 3 concepts at the end so that you can take some of this education and begin the process of applying it to your own situation. So just very quickly, like I told you before, my name is Brad Gatto. I'm going to be your educator for today. I happen to live in the state of Minnesota. I own a wealth management firm here in the Twin Cities area. Married, got a couple of boys. There's some more information in the handouts, which I'll talk about in just a second on the right-hand side of your screen. You can learn more about me if you want to know who I am. Also, if you want to know more about my firm and who we are and why we're your educator for today, you can go to our website to figure out everything you want to know about fiat. On the bottom of the screen there, you can see the URL, www.fiatwm.com. Bottom line is pretty simple. We specialize in this area of distribution planning or income planning for retirees. So I also want you to know that while we go through today's workshop, inevitably you're going to have questions, you're going to have concerns, and things are going to come up as I'm educating you. And although I don't have time to pay attention to the chat box, I do have a resource for you over there. And so, Dan, wouldn't you mind kind of popping your camera on just really quick for everybody? There he is. Daniel Colvin is going to be in the chat box for you today. Daniel is a highly trained fiduciary advisor in this area of distribution planning and tax planning. So, Danny, thanks for joining us today and taking care of that chat box for everybody.
Thanks, Brad. I put a comment in the chat box, guys. So if you see it, that's exactly where you can put in any and all questions. There is no such thing as a bad one.
Perfect. Thanks, Danny. And thanks for manning that chat box for us. It's vitally important. Also, I told you there's a lot more resources available for you other than just this 60 minutes of education you're going to get today. A lot of these resources can be found at our website. These are all just free for anybody that attends our webinars. We do workshops, educational workshops. We have a podcast. We write blogs. There's just all kinds of things. And so if beyond this education you get today, you want even more, the good news is we have it. Also, we have additional resources in the handouts tab for you on the right-hand side of the screen. So if you all take your eyes and put them over to the right-hand side of the screen, you will notice a tab called handouts. If you click on that tab, you're going to see it. 6 handouts in there. Some of them are just more information on who we are. If you just want to figure out who your educators are, that is there. But also there's some tax charts there for you. And there is something called a TIR workbook. TIR stands for Taxes and Retirement. This is a guided note-taking session for you. So if you are a note taker and you want to take notes during today's webinar, feel free to click on that, print that out, and take any notes that you would like. Or just print it out and save it for later, because there's a checklist as a part of it to make sure that you're taking advantage of all the things we discussed today. Last but not least, as far as resources are concerned, we do offer a complimentary tax clarity visit following today's webinar. What this does is it allows us to help you get started with all the education that you're going to receive today, because it's great to become educated in this area, but it's really hard to know how to take that education and apply it to your personal situation. And so we're going to, at least as an additional resource after today, help you get started. And so we want every single one of you to schedule that 30 minutes with Danny, this highly trained tax professional, this fiduciary advisor that can help you begin this process. We'll talk a little bit more about what this looks like today and who this makes sense for. But in the bottom left-hand side of your screen, just so that you can see it, you'll see a schedule now pop up. And there's a little kind of purplish blue link. If you click on that link right now, just so you can kind of see what this is all about, it's going to take you to an online calendar. That calendar is going to allow you to schedule that 30 minutes to begin the process of taking some of the education and some of the concepts that you learned today and applying those directly to your own life. We're going to give you some tax guides just for scheduling that visit. We're going to give you some tax reports and some tax maps. If that doesn't sound familiar to you, it will by the end of today's educational workshop. Last resource. Recently, I wrote a book called Spending Money and Having Fun, a practical guide to your fearless retirement. The book is all about everything we're going to discuss today and a lot more. It goes beyond just taxes, and it talks about all the other major areas affecting retirees today. In my 16 years in this industry, I can just tell you some of the biggest, not just mistakes that people make in retirement, but the biggest fears that they have lead to them not spending their money the way that they would want to, or giving it away the way that they would want to. And so I kind of wrote a book on the topic to allow people the education to receive the freedom to do just that. And so if you schedule that 30 minutes, the other thing we're going to give you as a complimentary resource is a copy of that book. So as we dive in, I would love to know who is here. So if you would, in the right-hand side of the screen where Danny is living, there's a Q&A box, okay? On the right-hand side of the screen, everybody click on the tab that says Q&A. That Q&A box is going to bring you into a private area where you can ask any question that you want to ask, make any comment that you want to make. Those come to Danny and I privately. Everybody else in the webinar cannot see them. I would like for you to do me a favor and answer 2 questions for me so that we know who we're talking to today. Number 1, what questions or concerns do you have? What brought you here today? You're not spending 60 minutes out of your day to learn about taxes and retirement because you don't have questions or you don't have concerns. And so let us know what brought you here today and what your primary objective is by attending today's webinar, or what you're hoping to get out of today's webinar. And then also, if you would, let us know if you're retired yet or not. If you're not yet retired and want to provide some color, I'm not retired, I'm retiring in 5 years, I'm a school teacher, or I'm retired, I retired 5 years ago, I was an engineer, or whatever it may be, the more details, the better. It just helps us to interact with you as we go throughout today's webinar. Because at the end of the day, you guys can see me and you can hear me, but I cannot see you and I cannot hear you. This is our way of interacting. So go ahead and jump in that Q&A box. While you're answering those questions, I'm going to play us a short video to get going.
I've ever made in my entire life has been wrong. My life is the complete opposite of everything I want it to be. Every instinct I have in every aspect of life, be it something to wear, something to eat, it's all been wrong. Everyone.
Tuna on toast, coleslaw, cup of coffee.
Yeah. No, wait a minute. I always have tuna on toast. Nothing's ever worked out for me with tuna on toast. I want the complete opposite of tuna on toast. Chicken salad on rye, untoasted, with a side of potato salad and a cup of tea.
Well, there's no telling what can happen from this.
You know, chicken salad's not the opposite of tuna. Salmon's the opposite of tuna, because salmon swim against the current, and the tuna swim with it.
Good for the tuna.
George, you know that woman just looked at you.
So what? What am I supposed to do?
Go talk to her.
Elaine, bald men with no jobs and no money who live with their parents don't approach strange women.
Well, here's your chance to try the opposite. Instead of tuna salad and being intimidated by women, chicken salad and going right up to them.
Yeah, I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes. I will do the opposite. I used to sit here and do nothing and regret it for the rest of the day. So now I will do the opposite and I will do something. Excuse me, I couldn't help but notice that you were looking in my direction.
Oh, yes, I was. You just ordered the same exact lunch as me.
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
All right. Well, that's just a fun video to play while you guys have a chance to answer those questions. But it does do something for us. And what it does is it kind of sets the stage for the most common comment that I get after doing this educational webinar. And that is, Brad, it feels like after this education, you're telling me to do the opposite of everything I've been told to do as it relates to taxes my entire life. Kind of like George in that video. And that is kind of true. But as I was talking about before with this idea of mountain climbing and descending that same mountain, when the muscles that you use and the things that you do and the path that you take to climb a mountain are very different, or the opposite, obviously, of what you do to get down the mountain. And the treacheries and the dangers involved in the descent are just different. And so as we talk today, whether you're nearing retirement or you're in retirement, thank you for answering those questions. By the way, we've got people on both sides of that fence. You just need to know what's coming if you're not yet at the top of that mountain, or what you're dealing with on the way down. And so we're going to dive in to what the problem actually is here. You see, they've been taxing you and I directly through ordinary income taxes since 1913. And since that point in time, tax rates have changed a lot. As you can see on the graph here, this is the top tax rate from 1913 through today. In 1913, the top tax rate was 7%. You can see in the Great Depression era, it spiked up into the 60% range. And after World War II, it spiked to 91%. And since that time, in the 70s, it was around 70%. And we've been lucky enough that over the last 3 decades, the top tax rate has hovered in the mid to upper 30% range. Now, interesting to note, in the mid to late 1970s is when the IRA and the 401k were invented. Make no mistake, if you went to climb Mount Everest today, you would not be a trailblazer. The first person to climb Mount Everest was in 1953. But still, not a lot of people have done it. Your generation are trailblazers as it relates to this idea of a modern retirement, and not just this idea that you're going to be retired potentially for decades, but also you're the first generation to have to save their own money to do it. You see, the height of the pension was way back in the 1960s. And since that point in time, less and less people have pensions, and they've been replaced with IRAs and 401ks. In other words, the onus has been on you to save your own money. Now, that doesn't mean that everybody on this webinar today doesn't have some sort of pension, but you are the first generation to be able to put your own money away on a pre-tax basis because of the invention of the IRA and the 401k. The problem that has created is that most people's savings that they have to live on in retirement looks something like what you see on the screen. The vast majority of your money is sitting in a bucket that's never been taxed. The green slice of the pie is your IRA and 401k, 403b, 457 type money. The after-tax bucket is blue. The yellow bucket is this tax-free bucket. This is pretty new for most people, so therefore a relatively small portion. Now, these are just averages. This may not be exactly what your situation looks like, but I've talked to thousands and thousands of your peers, and this is the average case that I see. The problem with this, of course, being the vast majority of money that you've saved, you've never paid a tax bill on, which means eventually you do have to pay those taxes. So as we dive into Taxes 101, I just want to be very clear. I'm not a CPA. A CPA's job is to file your taxes for you. At the end of the year, you get all of your invoices and receipts and 1099s together, and you go to your CPA and you say, hey, here's everything that I did last year. Can you file this for me? My job is not to do that and look backwards to file your taxes for you. My job as a retirement income certified professional is to help you look forwards and minimize the tax impact you can have, not only this year, but next year, 5 years, 10 years, and actually even maybe possibly after you pass away. So diving in, Taxes 101, how do they work? We're going to cover your 1040 very quickly so you can at least understand in the first handful of pages of your taxes why you end up with the tax bill that you end up with. It all starts with the tax brackets. And so we're going to use an example today of a married couple. And I'm going to stick to a married couple example for consistency throughout today's webinar. Make no mistake, if you are a single filer, your concepts are exactly the same as a married person. Your numbers are going to be different. And so in the handouts tab, we do have those tax sheets. And so as a single filer, if you want to look at your own numbers, please reference the handouts tab and grab those tax sheets there. Married couple. In 2023, if you're a married couple, the tax brackets look like what you see on the screen. I call this the 7-bucket system, very simply because there are 7 tax brackets. They start at 10%, as you can see on the screen, and they end at 37%. What most people don't understand is that these buckets are filled as you go. And so I'm going to use an example. Let's say you're a married couple and you have $100,000 of taxable income throughout the year. If you look at our screen here, that would tell you that you're in the 22% marginal tax bracket, because 22% is a range between $89,450 and $190,750. So $100,000 would fall in that bucket. That does not mean you pay 22% on all of your income. The way that our system works is everybody starts at the 10% bucket. You fill up that bucket, which in this case happens to be $22,000. The first $22,000 of income that comes in the door, you pay 10%. Once that bucket is full, you can no longer put another dollar in there. You have to go to the next bucket. That's the 12% bucket. And so between $22,000 and $89,450, you're going to pay 12%. And then for this married couple that's making $100,000 of income or has $100,000 of income, the last money is between $89,450 and, in my example, $100,000 would be actually taxed at that 22% rate. And so I always visualize this as kind of that fountain in your backyard, right? That bird bath or that fountain where it starts at the top of the fountain, fills up the first reservoir. Once that is full and the water is filled up that reservoir, it spills into the next one, then it spills into the next one. Once that one's full, so on and so forth. That's the way the tax code works. And so if you're a married couple with this $100,000 of income, it is true that your marginal tax bracket is 22%. But that does not mean you pay 22% on every dollar that comes in the door. Now, we should also note here that we're living in a very interesting time where we are all under this Tax Cuts and Jobs Act that was passed in 2018. Major tax legislation is a pretty normal thing. It's very rare that we go very long without having some major piece of legislation. But in 2018, there was a very significant piece of legislation that we all need to be aware of, called the Tax Cuts and Jobs Act. The reason it's so important that we're aware of the Tax Cuts and Jobs Act, or TCJA for short, is because it put taxes on sale, or it made them cheaper for the vast majority of Americans. Not everybody, but the vast majority of people saw a reduction in their tax bill because of this tax act. It's important because if your taxes are cheaper today than they were a couple of years ago, you should want to know about that, especially because the Tax Cuts and Jobs Act is not permanent. It expires. It expires in 2025. So in tax year 2026, the sunset of the Tax Cuts and Jobs Act is going to revert you back to the old tax law in 2017. In other words, in layman's terms, what I'm telling you is your taxes are on sale today and the sale expires. It's kind of like a Black Friday type thing. You got to buy it now, or if you wait until after the fact, the sale is going to be gone and you're going to pay full retail price. One of the provisions, there was 23 provisions that affected you and I, net, made them cheaper for the majority of people on this webinar today. One of them, as an example, was these tax brackets. Pre-Tax Cuts and Jobs Act, the 10% bracket was 10%. That did not change. But the 12% bracket used to be 15%. The 22% bracket used to be 25%. The 24% bracket used to be 28%, so on and so forth. So that's one of the provisions where we saw a decrease in overall tax bills. One of the things I want to do is kind of give you this visual. We call this a tax map. If you put the tax code into a graph, it looks like a set of stairs. And so across the bottom, you've got income coming in the door. And the graph shows you the appropriate tax rate you're going to pay as your income comes in the door throughout the year. And so you start at that 10% rate that we talked about before, then 12, 22, so on and so forth. What's interesting to note when you graph this out, though, and you can see visually now, that every step or every stair in the tax code is different. The rise and run are different. Some of the buckets are bigger, some of them are smaller. The jump from one bucket to the next, some of them are small jumps, some of them are large jumps. In fact, I've highlighted a couple of numbers there, and those are the largest jumps in our marginal tax code. When you go from $1 to the next, you can go from a 12% rate to a 22% rate. That's an almost doubling of your tax bill from $1 to the next. And it happens again later in the code between 24 and 32. That's not a doubling, but it's another large or significant step from $1 to the next. Of course, this is going to represent some planning opportunities. We will continue to discuss this as we go throughout today's educational workshop. So now that you understand the 7-bucket system and you understand that the first dollar for everybody, no matter where you end the year, whether you end the year at $40,000 of income, $100,000 of income, or $400,000 of income, everybody starts in that 10% bucket and you fill them up as you go. The last bucket you end up in is your marginal tax rate. But that's the 7-bucket system. Every type of income that comes in the door is taxed at that 7-bucket system or ordinary income tax rates, except 2 things. There are 2 things that you do not pay ordinary income taxes on. They have their own set of rules and they have their own buckets. I'll come back to the screen in just a second. I call this the 3-bucket system. You can probably imagine why, because there's only 3 tax brackets here. Capital gains rates only have 3 buckets. There's a 0% bucket, a 15%, and a 20% bucket. And the taxable income associated with those buckets you can see on the screen. That said, the 2 things that fall into the 3-bucket system are capital gains and qualified dividends. If you have long-term capital gains coming off of a non-retirement account, or you have qualified dividends coming off of a non-retirement account, those two things are going to get this preferred or preferential tax treatment. Why do I say it's preferred or preferential? Well, because it's cheaper. It's less. Of course, if you could pay less in taxes, we all would like to do that. And so if you can get long-term capital gains or qualified dividends, as opposed to any other type of income, you're going to pay less in taxes, a preferred or preferential rate. So what are capital gains and qualified dividends? Capital gains are gains spit off by your non-retirement accounts or your non-qualified brokerage accounts or your non-retirement investment accounts. There's a lot of different names that people call these, but the bottom line is this was money that was in your checking account at some point, right? It's money you earned, you paid the tax bill on, and you chose to invest it, and not in an IRA. You just went to a brokerage account and bought a stock or bought a mutual fund or bought some sort of investment. And over time, that investment goes up in value. Let's just say you started with $1,000. It turns into $2,000. Well, the $1,000 you started with was checking account money. So that's money you've already paid taxes on. You don't have to pay that tax again. But the growth of that money, you do have to pay taxes on. The growth of that money is considered a capital gain. And if it's a long-term capital gain, in other words, you've held that position for at least 1 year, very important that you know this, you're going to get this preferred or preferential tax treatment. If you bought a stock and sold it 30 days later, that's a short-term capital gain. That's less than a year that you held that position. They're going to kick you back to the 7-bucket system and make you pay full retail ordinary income tax rates. But any long-term capital gains you have, you're going to pay less in tax. And then dividends. If you have stocks that spit out dividends and those dividends are qualified, you will also get this preferred rate. The primary thing that makes a dividend qualified is if it comes from a United States domiciled company. And so if that dividend is coming from Apple stock, that's a United States domiciled company. That's going to be a qualified dividend. Now, there are some holding rules to qualified dividends as well. That's a little bit too in the weeds for our educational workshop today. But if you have additional questions on kind of the holding periods of what makes a dividend qualified, go ahead and throw that in the chat box or use that 30-minute tax clarity visit to get those questions answered. But bottom line is there's two different tax systems or brackets, the 7-bucket system and the 3-bucket system. 7-bucket system is everything except long-term capital gains and qualified dividends. Those are full boat retail rates, I call them. The 3-bucket system is preferred or preferential rates. But again, we only have two things that fit into that bucket. Here's what the tax map looks like when it comes to capital gains. Starts at 0, like we talked about before. That's a great rate. Then they go to 15% and then ultimately end up at 20% at over $500,000 of income. Now, at the end of the year, when you go to file your taxes, the first thing you do is add everything up. What's all the income that came in the door, whether that's 7-bucket income or it's 3-bucket income. Doesn't matter if it's something preferred or preferential, like a long-term cap gain or a qualified dividend. You add it all to your 1040. Then you start subtracting things. You get to deduct things or you get credits back. Now, exemptions used to be a part of the tax code as well. Everybody used to get to exempt $4,050 of income just for being alive, for everybody in your household. They did away with those. But what they replaced them with was a larger standard deduction during the Tax Cuts and Jobs Act. So in 2023, if you're a married couple, you get a standard deduction of $27,700. Single filers, $13,850. So what does that mean? That means that the first $27,700 for a married couple, you do not have to pay taxes on. So it's really not until you get to $27,701 of income that you actually hit the set of stairs that we looked at before. I'll show you that visual again here in a second. Single filers, $13,850. There is an additional deduction if you're over the age of 65 or if you're blind. If you're over the age of 65, your standard deduction of $27,700 you still get. But if you're married, you get an additional $1,300 to deduct per spouse that's over the age of 65. So that could be, if both spouses are over the age of 65, an additional $2,600. If you're single, you get an additional $1,700 to add to your standard deduction. Bottom line is you get a lump of money, a pile of money, however you want to look at it, that you don't have to pay taxes on. Everybody does. And so if you don't have any write-offs, we always talk about tax write-offs and things that you can write off. And we all know some of the usual suspects, whether it's property taxes or it's gifts to charity or things of that nature that you get to write off on your taxes. If your write-offs do not exceed the standard deduction, you will not write them off. You will just take the standard deduction. And so we all probably at least have heard of itemized deductions, which is just you keeping all of your receipts for all the things you can write off, certain healthcare expenses, your property taxes, your state taxes, your gifts to charity, and some other things. You're adding it all up and saying, okay, these are all the things that I can write off. If that does not add up to at least the standard deduction, of course, you're going to take the standard deduction instead because you want to write off as much as possible, right? If your itemized deductions exceed $27,700 if you're married or $13,850 if you're single, of course, you're going to take your itemized list of deductions instead. But every year, you get to make that delineation between a standard deduction or itemized deductions. There's also credits. So we all get to deduct a certain amount of income, but we can also get credits back on the actual tax bill. Credits are better than deductions if you can get them. Credits, there are all kinds of different credits inside of our tax code. To give you an example of how they work, I'm going to pick the top one here because it affects the most people on today's webinar, and that would be the healthcare tax credit. The healthcare tax credit is a credit for people that are out in the private marketplace getting health insurance. And so let's just say hypothetically, you're lucky enough to retire before the age of 65. The bad news is you lost your employer-sponsored health plan. The other bad news is you're not old enough for Medicare. So you have to go out to the private markets to get your own health insurance. It is possible to get a tax credit. Another way to look at that would be to have the government help you pay for your health insurance. The credits are going to be determined by what your tax return looks like, specifically what your modified adjusted gross income looks like. But there are credits out there to be had. On the right-hand side of your screen in handouts, one of the handouts is a tax report. The tax report is something that we can generate for everybody on the webinar today. And so if you're wondering, gosh, I don't know exactly what my marginal tax brackets are. I don't know if I'm missing out on any credits. I don't know exactly what my taxable income looks like, things like that. We can create a very simple report for you during that tax clarity visit, at least begin that process and help you understand if you're eligible for any credits, if you're itemizing or taking standard deductions and things of that nature. So looking at deductions and adding those into our set of stairs or visualization of the tax code, what you can see here is the deductions keep you at a 0% rate all the way through the deduction. So a married couple, $27,700, you don't have to pay any taxes on the $27,700 at the beginning of the year. Once you get to $27,701, you now start paying 10%. You fill up that bucket, go to the 12% bucket, so on and so forth as you walk that set of stairs. Now, at the end of Taxes 101, here's a checkpoint for you. If you printed off the guided notes, these checkpoints are going to be on those notes for you as well. But here's kind of the key takeaways that I want to make sure you got out of Taxes 101. One, have you taken advantage of the Tax Cuts and Jobs Act? Do you know if your taxes are on sale or not? Are you one of the vast majority of Americans that saw a reduction in your tax bill? Yes or no? If you can't answer that question, we can help you answer that with the additional resources and that tax clarity visit. Have you taken advantage of the different tax buckets, the 7-bucket system versus the 3-bucket system? And then have you maximized your deductions and credits on your taxes? And so if you can't check all 3 of those boxes, these are the things these additional resources can help you out with after today's educational workshop. All right, jumping into Taxes 201. These are additional complexities for retirees. We're going to walk through RMDs, capital gains, Social Security, and Medicare. RMDs, what are they and how do they work? Well, we actually just had a massive change to this in 2023. At the end of 2022, they passed the Secure Act 2.0. Now, it's a 400-page document, and there is a lot in there. But one of the things that they updated was the age you have to start taking RMDs or required minimum distributions. Now, if you're unfamiliar with what an RMD is, very simply put, if you have pre-tax money, IRA money, 401k money, 457 plans, 403b plans, anything like that, the IRS forces you to start taking distributions from those accounts at the magical age of now 73. Now, it's interesting to note because pre-59 and a half, you could not touch this money, right? If you touch this money pre-59 and a half, the IRS was going to penalize you. They said, this is retirement money. You have to defer this money. You have to wait. Then at the age of 59 and a half, the IRS says, okay, no more penalties. You can take the money out as you see fit. You just have to pay the tax bill. All the way through your 60s and your early 70s, that's the case. Then at 73, they have the opposite tune. They don't say anymore, you can't touch the money or I'm going to penalize you like they did in your working years. They now say in your retirement years, you have to touch the money or I'm going to penalize you. They want you to take that money out and pay the tax bill. So at the age of 73, you have a minimum amount that you have to take out. How do you know what it is? Well, you have to use a uniform lifetime table to figure out how much you have to pull out. Here's what the uniform lifetime table is. And so in the first year, we'll highlight one example here. You're age 73, right? Your distribution period, as you can see, as I've highlighted on the screen, is 26.5. So what do you do with that? Well, you go back to figure out what your total pre-tax balance was on December 31st of last year. Once you figure out what that is, you take that balance and you divide it by that distribution period. So in my example, as you can see in the yellow box, we've got $1 million balance on December 31st. My distribution period is 26.5 because I'm 73 years old. My million divided by 26.5 means that this year I have to pull out $37,736. Now, that is 7 bucket money. That's going to hit your 1040 right on that front page, and you're going to have to pay 7 bucket full retail rates when you pull that out. It's just important to note that this is a requirement. It's also important to note, if we go back to this screen, that the distribution period every year you get older changes. So in the example I gave you, it was 26.5, but the very next year it's 25 and a half. Look 10 years down the line, it's 17.7. So the distribution period keeps going down, which means your RMD as a percentage of your account value will continue to go up. So when it comes to RMD planning, it's really important to know that this is going to get added to your 1040 at the end of the year. And you may be like, you know what, Brad, I don't need that money. But you're telling me I have to pull it. Yes. So even if you don't spend that money, this, in my example, $37,000, you do have to pay taxes on it. Even if you take that money and just save it into your savings account, or you resave it into a brokerage account, or whatever it is that you do with it, it's taxable to you at the end of the year. It's also important because when you get into your 70s and they force you to start taking these distributions, it can affect other areas of your 1040 and essentially cause a double or triple taxation. We're going to get more into what that looks like in just a second. There's a bonus item here, though, I do want to mention, and that is QCDs. QCDs stands for Qualified Charitable Distributions. And what that means is you can take these RMDs and not take them into your life or put them into your checking account and pay the tax bill. You can gift them to a charity, therefore not having them be taxable to you and having them not be taxable to the charity, and also skipping over having to itemize your deductions to get your charitable contributions to matter from a tax perspective. So you can kind of have your cake and eat it too. You can take the big standard deduction that we get during the Tax Cuts and Job Act, 27.7 this year for married couples, and still QCD your RMDs at the same time. So if you are a charitably minded person, what you should take from this is the concept that you shouldn't, give as your heart tells you to give. I don't want to take that away from you, but there are some tax strategies to also get a tax impact out of these gifting strategies. QCDs are just one of the many gifting strategies you can take advantage of to make sure you get the biggest tax deduction you can for the gifts that you're making to these charities. The second thing we're going to talk about is capital gains. Now, capital gains, again, are from non-retirement accounts. This is growth in your non-retirement accounts or your non-qualified brokerage accounts. So these are typically, like we talked about before, taxed at the 3-bucket system, assuming that your positions were held for at least a year. But also interesting to note that mutual funds have something we call through pass-through or phantom gains. And so this can affect your taxes at the end of the year. And so you could be getting an RMD that you may or may not want. And now all of a sudden you may be getting capital gains that you may or may not want. How does that work? Well, if you own mutual funds, you and thousands of other people own that same fund. And throughout the year, there are people buying into the fund and there are people selling out of the fund. And so the fund is required to buy shares and sell shares throughout the year to take care of the purchases and the redemptions. all of that trading inside of the fund, even if you never sold the fund, you held it all year long, but other people bought and sold, those transactions are going to come back to you, and they can cause capital gains for you, even though you didn't sell out of a position. People historically just think of their capital gains, if they're familiar with them, that it's a 15% tax, essentially, when I go to sell out of my shares. But sometimes you start getting these phantom gains where you haven't even sold out of your shares and you're still getting a gain. I've even seen it where at the end of the year, maybe a year like last year, you have a loss in the mutual fund. You have less money at the end of the year than you did at the beginning of the year, but yet you still are getting capital gains or 1099s from that mutual fund at the end of the year because of transactions that were happening in the middle of the year. So it's important to know what you're invested in and how that can affect your taxes, because at the end of the day, the more control you can have of when and how your taxes come in the door is going to help you minimize your overall tax bill long term. Now, if that wasn't enough, having RMDs come in the door, whether you want them to or not, getting capital gains come in the door, whether you want them to or not, can also affect how you're taxed on your Social Security. Your Social Security has its own set of rules on how it's taxed. Conveniently enough, they call it provisional income. And so if you've got your Social Security turned on, it's important to understand how that's being taxed and how other things like capital gains, RMDs, and otherwise can affect how this is being taxed. So provisional income is a calculation. It's a math equation. It's an addition equation. They're going to take four things and add them together. Half your Social Security benefit, all your 7-bucket money, all your 3-bucket money, and any non-taxable interest that you have. Okay. Important to make note of, it's only half your Social Security benefit. Okay. Half your benefit, all 7, all 3-bucket money, and any non-taxable interest you have. That equates to whatever the number is. Once they have what that number is, they take that number and they apply the thresholds you see on the screen. So as a married couple, the first threshold is $32,000. The second threshold is $44,000. The bottom line is, if your provisional income calculation is less than $32,000, you won't pay any federal taxes on your Social Security. If it's over $44,000, you're going to pay taxes on 85% of your benefit. 15% of your benefit is going to come to you tax-free. Again, also important to note, everybody, no matter what your provisional income is, gets at least 15% of your Social Security benefit tax-free. Everybody. Okay? Some people get all of it tax-free, depending on what their provisional income calculations are and how those apply to these thresholds. I think it's easiest if I just give you an example. Okay? So in the first example on the top of the screen here, we've got a client or a retiree that needs $60,000 a year of income to live on. Well, in their situation, they have $20,000 of Social Security, so they pull $40,000 out of their IRA to get to that $60,000 of income they need or want to live on. So now we got to figure out how that's going to be taxed. Well, in order to do that, we have to know what their provisional income is. Well, in this example, the provisional income is $50,000. Now, they have $60,000 in total income, but the provisional is only $50,000. Why? Because remember, only half of the Social Security benefit counts. So in this example, half of 20 is 10. All of the IRA counts because that's 7-bucket money. So 10 from the Social Security, 40 from the IRA gives us $50,000 in provisional income. You run that through those thresholds that I just showed you on the previous screen. The net result, 55% of this retiree's benefit is going to get taxed. 45% is going to come to them tax-free. Second example, retiree number 2 wants the same amount of money. Okay, $60,000, but they have a lot more Social Security coming in the door, $40,000 in Social Security. So they only have to take 20 out of their IRA to get to that $60,000 of income. Now we have to figure out what their provisional income is. Well, it's different. It's only $40,000 because remember, only half of the Social Security benefit counts. So run that through those thresholds, and what you'll see there as the net result on the right-hand side of the screen is only 10% of this person's Social Security benefit is going to be taxed. 90% is going to come tax-free. Couple of things here. Bells and whistles should be going off in your head. Couple of things. Number one, it's not about how much income you live on in retirement that determines what your tax bill is going to be. It is where your income comes from. Retiree 1 and retiree 2, same amount of income, very different result in how their Social Security is taxed. Okay. Point number 2, stop talking to your neighbors about what they're doing, because although they may live on the same amount of money that you live on, or your brother or whoever you go to for financial advice, their situation could be vastly different than yours, even though some of the key facts may look exactly the same. Last but not least is Medicare. So you may be the retiree that has RMDs you don't want. You may be the retiree that's getting capital gains that you don't want. In fact, all of that affecting how much of your Social Security is taxed, which means the more of your Social Security that's taxed, the more of it that hits your 1040, also bringing up your income at the end of the year. And all of this could be happening and affecting your Medicare premiums. You see, at the age of 65, you now are eligible for Medicare. Once you receive Medicare, you do not have to pay for Part A. You are finally done paying for that, right? But you do have to pay for Part B and Part D. The premiums that you pay are income adjusted. Okay. So the higher your income goes, the more you pay for premiums on Part B and Part D. The chart that you see there kind of lays this out. Now, for a married couple, the increase above base rates does not happen until your modified adjusted gross income is over $194,000. And then you're going to start to see some increases in both your B and D premiums. Now, a lot of you on today's webinar may be thinking, Brad, I don't need $194,000 to live on in retirement. And for married couple, for single filers, about half of that. I don't need that much. And so I don't have to worry about this. And while that may be true, your modified adjusted gross income is not always indicative of how much money you need to live on, because you could have RMDs coming in the door you don't need. You could have capital gains coming in the door you don't need, which increases your provisional income and how much of your Social Security hits your 1040, therefore bringing your modified adjusted gross income up above these thresholds, even though you're living on significantly less income than that. I see it quite regularly. In fact, I've seen it plenty of times where somebody gets the magical age of 73, where they have to start taking RMDs. And not only does that create excess Medicare premiums for them, but it jumps them one or two of these brackets just because they didn't have an RMD plan going into their age of 73. To this point, with all four of these kind of key areas in Taxes 201 that we talked about, required minimum distributions, capital gains, provisional income, and Medicare, all of these things tie together. They all affect your modified adjusted gross income, and they can affect the effective marginal tax rates that you pay. To this point, we've defined and talked about marginal tax rates, but we have not talked about effective tax rates. Let me give an example of what I'm talking about. So for quick review, here's the tax map again, or the set of stairs that we talked about before. Now we're going to walk through a case study. So we've got a married couple here. They're over the age of 65. In fact, one of them is over the age of 73. So they have a required minimum distribution. Between the two of them, they have $60,000 in Social Security coming in the door. They have $15,000 of net long-term capital gains. Now, they didn't want those capital gains. These are phantom gains that came in the door through mutual fund positions that they held. And they also have this $45,000 required minimum distribution that they have to take out of their pre-tax accounts. Also, not something this couple needed. Their Social Security was enough for them to live on, but just because they only spent 60 doesn't mean their taxable income is going to be 60. So let's walk through what their set of stairs looks like. The yellow in this example is the set of stairs we've been looking at this entire time. The gray is the effective rate of taxes they paid, federal taxes, as they walked the set of stairs or as the income came in the door. Now, a couple of things should stand out to you. First and foremost, their starting tax rate, once they got through deductions, was 18.5%. Now, I educated all of you a couple of minutes ago that the first tax bucket was 10%. So why, when they hit the set of stairs, are they 18.5%? And not only that, but later in the tax code, when they should be paying a 12% rate, there's a period of time where effectively they're paying almost 50%, 49.95%. Because intuitively, like we talked about before, your marginal rate should be what you pay as you walk the set of stairs. And unfortunately, it doesn't always work that way, especially in retirement. Let's walk through how it happened. Intuitively, if you're in a 12% tax bracket and you pull $1,000 out of an IRA, your tax bill should be $120, which is true. But what actually happens is you pull that $1,000 out of your IRA, you do have to pay that 12% rate of $120. But that IRA distribution changes your provisional income. In other words, it takes money from your Social Security that wasn't taxed, some of your Social Security income that wasn't taxed before, and makes it taxable. So I have to pay that bill too. In this example, it's $850 now gets taxed that wasn't being taxed before. The reason it's not $1,000, remember, is because everybody gets at least 15% tax free. So that $850, now I have to pay the 12% rate on that as well. That's $102. Those two things in tandem affected my adjusted gross income, which took some of my capital gains that were in the 0% bucket and pushed them into the 15% bucket, therefore causing a tax bill there as well. That's a 15% rate on the entire $1,850, the $1,000 IRA withdrawal, plus the additional $850 of Social Security that's now taxable. That tax bill is $277.50. So that $1,000 IRA withdrawal caused three different taxes, total bill $499.50. So the effective rate that they paid was 49.95%, even though they're only in the 12% marginal tax bracket. You see, as retirees, it's really, really important to understand when you're talking about how to minimize the impact of taxes in retirement is it's not, again, how much income you live on in retirement that's going to determine what your tax bill is. It's where your income comes from, what other sources you have coming in the door that you want them to or don't want them to, things like RMDs and capital gains, and having control over those into the future. Checkpoint. Have you performed any current or future RMD planning? So this is something that all of you should be doing. If you're already of the age of 73, last year 72, and you're in RMDs, it doesn't mean it's too late for you. It just means you have more limitations on what you can and cannot do. But it doesn't mean you should be doing nothing. So if you do not have a plan for RMDs, that's something that we can help with, at least get you started, okay? Have you efficiently allocated your investments to lower turnover, capital gains, and unforeseen expenses? Have you planned to maximize your Social Security in retirement? Have you performed efficient income planning to maximize your retirement paycheck? And then have you prepared any tax planning to avoid excess taxes? And so when you think about these four key areas of RMDs, Social Security, capital gains, and Medicare, it's really important to understand how they affect your 1040. Other than the known things coming in the door, if you have earned income, if you have pension income, and things of that nature. All right, let's leave with an immediate impact here. So what do we do about this? How do we solve for all these additional taxes we could be paying in retirement? First and foremost, we want to diversify your money amongst different account types. Use tax-deferred products only where appropriate. Blending withdrawals, making sure you don't pull all of your money out of IRAs or just all of your money out of non-qualified money or all out of Roth or whatever it may be. Sometimes it makes sense to do a little bit of everything. And then consider which assets should be held in which account type. So I'm going to give you three concepts that's going to drive those points home, okay? First concept is called three types of money. The second one is to defer or not to defer. And the last one is what we call the widow's tax. So diving in, three types of money. When it comes to taxes, there's only three buckets you can invest in. Now, when it comes to investments, there are thousands of options out there for you, right? Whether it's individual stocks, it's packaged products like mutual funds and ETFs, it's private placement things, it's bonds, whatever it may be. Thousands of options. Taxes, three. So let's walk through all three options. On the left-hand side of the screen, we're all going to make an investment decision together. We're all going to buy ABC company stock, just a hypothetical stock, okay? Now, ABC company stock can only do two things. It can go up in value or it can go down in value. But we've decided together today, everybody on this webinar, that we're going to buy ABC company stock, and we think it's a good investment. That's why we bought it. In other words, we think it's going to go up in value. The next decision we make is not an investment decision. The investment decision's been made. That's ABC company stock. The second decision we have to make is a tax decision. Where do I want to buy ABC company stock? Do I want to buy it in the first bucket, which is a pre-tax bucket, the middle bucket, an after-tax bucket, or the last bucket, which is a tax-free bucket? Well, let's walk through the scenarios. If we bought ABC company stock and we were right and it went up in value, how do we pay taxes in the future when we go to use this money? Well, had we bought it in our 401k or IRA, we have to pay 7-bucket system, full boat rates, right? Ordinary income rates. Had we bought it in the middle bucket, we don't use pre-tax money to buy ABC company stock. Remember, it has to be checking account or after-tax money. And the growth of it, if it does go up in value, we're going to get that preferred or preferential rate. It's going to be cheaper, okay? 0, 15, or 20%. And then the last bucket, same thing. We have to buy it with checking account money, after tax money. The growth of it is actually not taxable at all, assuming you held the growth component for at least 5 years. In a Roth IRA, the growth is tax-free. Now, ABC company stock can also go down in value, right? I don't know if you've ever had an investment go down in value on you before. I'm sure we all have at some point. The bad news is it doesn't matter where you bought it from a tax perspective, pre, post, or free. If ABC company stock goes down in value, you're going to lose money. It just is what it is. But in the middle bucket, in that after-tax bucket, there is a little bit of a reprieve. You are allowed in your non-qualified investments to write off your losses on your tax return or use something called tax loss harvesting. The bottom line is if you have any money that's non-IRA money, non-retirement account money, brokerage account, non-qualified investment money, and you're not taking advantage of tax loss harvesting or using losses to offset gains to minimize your tax bill and things of that nature, there's a lot of tax strategies that can be used to minimize the effect of taxes paid in this bucket. So it's important to note. So if you're going to lose money, do it in the middle bucket, right? Also important to note, if you do not spend all of this money, had we bought ABC company stock in any one of these buckets and we didn't pull the money out for our own fun and lifestyle, instead we left it to the next generation, how did they pay taxes? Well, on the bottom of the screen in the blue, you'll see, had it been in a 401k or IRA, and you did not use the money and it went to the next generation, it is fully taxable to them as well. They don't get out of the tax bill. You deferred, chose not to pay the bill, and at your death, that deferral now gets kicked to the next generation, and they have to pay the tax bill. And they don't pay the tax bill at mom and dad's rates. They have to pay the tax bill at their own rates. Now, if mom and dad pass away 85, 90, 95 years old, typically the kids are in their 50s and 60s and typically have higher AGIs or adjusted gross incomes or higher tax bills than mom and dad did in their late 80s or 90s. And so a lot of times the mistake that I see for families is they've got all this money sitting in these pre-tax accounts and they've been told their entire life to defer all of that money. And then they do that, they pass away, it goes to the kids, and the kids end up paying a higher bill than mom and dad would have had they just paid the bill while they were alive. Okay? The second bucket is unique in the fact that you get what's called a stepped up basis. So use our example of ABC company stock. You buy it for $1,000. When you pass away, it's worth $100,000. You knocked it out of the park. Now, had you sold that position while you were alive, you're going to pay long-term capital gains on the $99,000 of gains you have. In my hypothetical example of investing $1,000, now it's worth $100,000. If you pass that on to the next generation, they get to step up the basis. The basis is what you paid for the stock. They get to step it up to today's stock price. If that's $100,000, the basis goes from $1,000 to $100,000. In other words, they get to act as if they paid $100,000 for the $100,000 investment, which means how much do they have in gains? Zero. Well, the only tax you pay is on gains. So if they pull it all out immediately, they have no tax bill. So the step up in basis is really unique and possibly something to take advantage of when it comes to estate planning or thinking about giving money to the next generation. Last but not least, the Roth IRA is tax-free growth for you while you're alive, assuming that growth has been held for 5 years. It's the exact same to the next generation. If the position's been held for 5 years, typically they're going to also receive tax-free growth of ABC company stock. Last but not least, the other thing that you need to be cognizant of when it comes to three types of money, pre, post, and tax-free monies is every single one of you on this webinar today, I would guess, has a diversified portfolio. In other words, not all of your money is in one stock like we're talking about today, like ABC company stock. You have multiple positions, and a lot of you probably have way more positions than you even realize that you have. You're very, very well diversified. And in that diversification, you have some investments that are less risky, and you have some investments that are more risky. Have you ever audited your portfolio to make sure that it's that the diversification that you have is tax efficient? What do I mean by that? Well, very simply put, it seems to me that the IRS incentivizes you to put your most risky investments in your Roth IRA and your least risky investments in your traditional IRA or your 401ks. Why? Well, think about it. If you buy ABC company stock because you think it's going to go up in value, and let's just say it's a super risky stock, Why would you ever even do that? Well, you do it because you think you can hit a home run. The only reason you would ever take that risk in your life is because you think that you can make money, right? Well, let's say you're right and you do hit a home run and your stock goes from $1,000 to $100,000. Well, ideally, you'd want that in your Roth IRA because all $99,000 of growth in my example, you wouldn't have to pay taxes on. Whereas if that was in the 401k, you'd have to pay ordinary income taxes on all of that growth. So the most risky investments, the kind of the home run hitters that you have, that you're trying to hit home runs, which means you strike out more often, but you have a better chance of making bigger returns, that should be in your Roth IRA. Your least risky investments, your more conservative investments should be in your IRAs. Stop trying to hit home runs where the IRS gets to participate with you in your gains, and typically at higher rates. If you're in the 22% tax bracket, you make $1,000 in your investment, then 22% of it belongs to the IRS. Another way to think about this is very simple. If you have $1 million in your IRA, you don't really have $1 million. I actually think it's quite ironic that it's called an IRA because IRA stands for Individual Retirement Account. When in reality, it's not an individual account at all. It's a joint account between you and the IRS. Part of that $1 million is yours, and part of that money still belongs to the IRS. You see, you have a loan or a lien out on that money. And it's not a matter of if you have to pay taxes on it. It's a matter of when you pay the bill and what rate you have to pay when the money comes out. And like we talked about here on this slide, it doesn't matter if you don't pull the money out while you're alive, the next generation still has to pay that bill. Second concept, to defer or not to defer. We get this question all the time. Well, Brad, with that said, should I be taking money out of my IRA now? Should I do it before RMDs? I've got the same problem you've been talking about this entire time. The vast majority of my money is sitting in a bucket that's never been taxed. What should I do? Well, can you take the money out of an IRA and then put it in your checking account? Absolutely. We all probably know you can do that. Did you know you can also take money out of an IRA and put it directly into the tax-free Roth IRA? Those are called Roth conversions. Now, it's interesting. Anybody can do this. There are no limitations, no age limitations, no income limitations, nothing. Anybody can take any amount they want out of their IRA, whether it be $1 or $1 million, and move that into the Roth IRA. But note, if you do it, you got to pay the tax bill on the way over there. So let's figure out if this is a good idea or a bad idea. My example here, tax rates are 25%. So should this person that has a $100,000 IRA convert the whole thing to Roth, they're going to pay the 25% taxes on the way over, which means only $75,000 goes into the Roth IRA. How do we know if this is a good deal or a bad deal? Well, in our magical world, we get to fast forward 10 years and find out. So fast forward 10 years, let's say they were invested exactly the same. And over that 10-year period, they both doubled in value. So had you left the money in the IRA, your 100 would have gone to 200. Had you converted to Roth, because you had to pay the tax bill, you only had 75 to begin with, that doubles, that goes to 150. This is where my industry kind of champions the superior cause of tax deferral. Because in this example, 10 years ago, there was only a $25,000 difference in value. Today, there's a $50,000 difference in value because 100% of your money got to work for you because it all was in that deferred state. But it's not about how much money you have. It's about how much money you get to keep. How much of that money is actually yours? So now it's time to spend the money. Now you're in retirement. It's time to spend the money. Now we have to pay a tax bill. So we have to take taxes out of both accounts. Let's just say hypothetically our tax rate stays exactly the same. It was 25% 10 years ago. It's 25% today. You pull the taxes out. Well, there are no taxes on the Roth, so the 150 is 150. In the IRA, you pull 25% out of the 200 and you have $150,000. So which one's better? Well, they're exactly the same. See, an IRA is just a bet. An IRA is saying, look, I'm not going to pay my taxes on this money today. I'm going to kick that can down the line because I believe my taxes are going to be less in the future than they are today. A Roth IRA is the opposite bet. It's, you know what? I'm going to pay my bill today because I believe my tax rates are going to go up in the future. So I'm not going to defer that bill to a higher rate down the line. Because if your tax rates don't change, it's a wash. One's not better than the other one. Of course, the problem is the majority of people, you and your peers, have the majority of their money in the pre-tax bucket, which means the vast majority of the money you save for retirement is making the bet that your tax rates are going to go down in the future. If you don't believe that, then you should be looking into this idea of Roth conversions. Now, massive disclaimer. Anybody on this webinar can do this, and you could take all of your IRA money or 401k money today and do this in 2023. Don't do that. Because just like you should be asking yourself the question, hey, you know what? He mentioned the Tax Cuts and Job Act and the fact that the majority of Americans' taxes are on sale. If my taxes are on sale, shouldn't I be paying some of the bill now and doing something like a Roth conversion? Possibly. But first, you have to be able to answer a lot of these checkpoint questions that we asked earlier in the workshop. If you can answer those checkpoint questions and we find out things like your taxes are on sale and what the rest of your 1040 looks like, we can then answer the question of, do Roth conversions make sense for me? And then the more detailed question of, well, how much should I be converting? I look at this like a bell curve, right? Where so much Roth conversion is good, but if you do too much, you start tipping back to the backside of the bell curve and it actually starts to hurt you more than it helps you. There is a line of efficiency here. And at the end of the day, all of us on the webinar want the exact same thing. We don't mind, well, maybe we don't all agree at this point, but we don't mind paying our fair share of taxes, at least what is required of us, right? But none of us want to tip the IRS every year and pay more than our fair share. And Roth conversions are one of those things that can really help people, but if we do too much or not enough, you're actually hurting yourself and you're giving that tip to the IRS each and every year. So if you don't know the answer to that question of, should I be doing this? Does this make sense for me? Then you're one of those people that should be taking advantage of that tax clarity visit because we can begin you down the path of answering those questions and at least get you started. Last concept is called the widow's tax. Now, if you're not married, hang with me, okay? Because if you're not married, you know somebody that is, and you could possibly have a massive impact on their life if you let them know about this concept. The bottom line is this. If you're married, what are the odds that you and your spouse die on the same day? Not good, right? The surviving spouse is considered a widow. Did you know that that widow, should they maintain lifestyle from an income perspective? And in my example, I'm going to give you, we've got a married couple living on $8,000 a month or $96,000 a year. When spouse A passes away and spouse B goes to their CPA and their broker and whoever else it is that they work with and tells them the same thing that in my 16 years, every client I've had who's lost a spouse has told me, which is, I just want to maintain lifestyle. Just lost the love of my life. I don't want to be worrying about my finances. Can I afford to maintain that $8,000 a month that I had when my spouse was still alive? Hopefully the answer is yes, but that's only half of the equation. The other half of the equation is that same $8,000 a month of income that they had while they were both living has a much different tax bill when you're single. As you see on the screen, when they were married, that $8,000 a month or $96,000 a year equated to a federal tax bill of $7,185. When the first spouse passed away, the surviving spouse now has to pay $12,711 of federal taxes. That's an average tax rate increase from 7.9 to 13.8%. Or if you want to look at it this way, that's an increase in their rate, their average tax rate of 75%. So let me ask the question one more time. What do you suppose the odds are that you and your spouse die on the same day? In other words, what do you think the odds are that this is going to happen to you? So when you're looking at minimizing the impact that your taxes can have on you, and you're sitting on money that's never been taxed, and you're doing it on purpose, you're deferring and deferring and deferring and deferring and deferring, you're trying to figure out how to get your money out of these pre-tax buckets as tax efficiently as possible, which also then could minimize your Social Security tax, also minimize capital gains tax, also minimize your Medicare premiums and all these things that we talked about before. A big thing to pay attention to is if you're filing as a married couple or if you're filing as a single filer. Because at the end of the day, if you are listening to this webinar and you are married, you have a deduction or exemption or credit or however you want to look at it that you will not always have. And so taking advantage of that may make sense for you and your family. So here's the final checkpoint, and this is an important one. Have you performed or planned to effectively allocate your money to the three tax buckets? In other words, have you ever audited your portfolio from a tax perspective, not from an investment perspective, to make sure that your least risky investments are in your IRA and your most risky investments are in your Roth IRA. If you've not done that, again, that's something that we can help you with in that tax clarity visit. We can perform that audit for you. Do you have an IRA exit strategy? Do you know how, when, and where you're going to be pulling money out of your pre-tax accounts to minimize the impact the IRS can have? In other words, you get to keep more of it and they get to take less of it. And is your plan currently set up for an unexpected death of a spouse? In other words, are you aware that when your spouse passes away that there's a massive tax impact on that? With that said, that kind of concludes the educational portion of our webinar today. The next steps, I told you at the beginning of today's workshop, there are drifters and there are doers. Typically, the people that attend these workshops are doers. You took the time to register, you took the time to be here, and you're going to want to take this education and put it into action. We just want to help you get started. And so let us help you take kind of that next step and take some of these concepts and some of these checkpoint items and put them into action. The bottom line is, if you've got any unchecked boxes, these checklist items, we can help you get started. And so the next step would be to, on that bottom left-hand side of the screen, click on that little purplish blue button that's going to pop up. If you click on that, that's going to allow you to schedule time with this highly trained fiduciary professional, Danny, who popped his head in here before, that's in our chat box. Schedule time with Danny, ask any and all questions that you have, and we will help you get started by giving you some tax guides. We're going to build you a personalized tax report and give you a customized tax map. These maps are what are going to help you decide, should you be taking advantage of some of the concepts we talked about today. Think of it this way. If you were to call me today and say, hey, Brad, how do I get to your house? I want to come over for dinner. What's the first question I'm going to ask you? Well, of course, it's going to be, well, where are you? I can't give you directions on how to get to my home until I know where you're starting from. And so in this tax clarity visit, we'll begin the process of figuring out where you're starting from so that we can show you the map of how to go where you want to go and ultimately minimize the impact the IRS can have on your retirement. Another way to say that would be to increase the likelihood of success. So make sure, if you're a doer and you want to begin to implement these things, that you click on that button in the bottom left-hand side of the screen, go to that calendar, find time that works for you and your family. As a reminder, we're also going to give you a free copy of the book if you're scheduling that today as an additional resource. And don't forget about going out to our website and taking advantage of all the free resources that we have for you, in addition to just the education you got on today's webinar. Thanks so much for joining us for today's webinar on taxes and retirement. I genuinely hope this is the most impactful hour you will spend with a financial professional in 2023. Have a wonderful rest of your day, and we'll talk to all of you in that tax clarity visit.